Hi everybody, we're going to go over some slides. Now this is the first time I've used this program, so bear with me if the ending gets a little weird, but I just didn't want us to lose this class period tomorrow while I'm off doing the Dean Search Committee interviews. And so this is the perfect material for us to review because you've already had it in your accounting classes. So we're going to talk about the balance sheet, the income statement, the statement of stockholders' equity briefly, and the statement of cash flows. And then we'll work some problems in class, especially with the statement of cash flows. We'll talk briefly about free cash flow, and we'll talk about the tax system in the United States. So let's see here. So in an annual report, as you know, again from accounting class, you know that there's the balance sheet, the income statement, the statement of stockholders' equity, and the statement of cash flows. And I told you in class the other day that Dr. Attaway said that if you're only given one statement, the statement of cash flows tells you the most information. But most of us talk more about balance sheets and income statements than we talk about statements of cash flow. That's a little more the purview of the accountants and the finance people in a business. So we're going to talk about those particular reports. So let's start with the balance sheet. Now, a balance sheet, if you recall, has, well, I wish I were there with you because I would ask you, so what does a balance sheet tell me? And you would say to me, well, it tells you the assets and liabilities of the business. And I would say to you, well, what does that mean? What if you were trying to explain it to your grandmother? How would you tell your grandmother about a balance sheet? What would you tell her that it tells you? And so you might say something like, well, it tells us about what we own and what we owe. And I would agree with that, certainly if we were talking about an individual's balance sheet. But I'm going to put it a little different way from a finance perspective, and that is it tells us about our investments and where we got the financing for those investments. Now, the next thing I would ask you is it historical or does it reflect market values? And you would tell me it's historical. So when we're looking at a balance sheet and it tells us that the stockholders' equity, for example, is $5 million, that doesn't mean that the company's worth $5 million today. It means that the company raised $5 million at the point when they sold the stock. So it's the historical values. That's changing a little bit in areas like banking, but generally speaking, historical values. And the assets are listed and the liabilities are listed from most liquid to least liquid. So from shortest term, closest to cash, to more longer term, further away from cash. So of course, cash would be the most liquid asset and it's listed first. Accounts receivable would be next. Inventory would be next. Now, notice we've got a fairly basic balance sheet here that we're looking at. There can be certainly lots of other short-term assets and long-term assets, but we're kind of looking at the basics here. So we're basically saying, okay, a business has got to have some money in the bank. It's got to have, they've sold some product on credit, and so people owe them. That's the accounts receivable piece. And the inventory piece is all the product that they have that's going to be sold and the goods in process, the parts that go into making the product. We might have other short-term assets, like if we have paid for something like training for our workers, but we haven't received the training, then that would show up as a short-term asset. So we might just have like this kind of miscellaneous catch-all category. The next thing you see is the fixed assets. Well, first of all, let's back up. So total CA stands for current assets, and we just, of course, sum those short-term assets. And short-term means it'll convert to cash in 1 year or less. And then we go on next to gross FA. FA stands for fixed assets, and you might also see this as property and plant and equipment or plant and equipment, but it's assets that the firm is going to use for more than 1 year. So here we're looking at gross fixed assets. I'm looking at the 2008 column of $1.2 million. You can see that's up significantly from the 2007 of $491,000. Now below that you see less depreciation or less DEP, and I hope you remember that that's accumulated depreciation. So that's all the depreciation on these assets over the life of holding the asset. So if we sold the asset, the depreciation would go away. So if you think about it, if you've got really old assets, then that accumulated depreciation, the amount that we're writing off each year, would be quite large, and it would look, and our net fixed assets might be very close to zero. If we've got brand new assets, if we've just made an investment, then the depreciation is going to be small relative to the gross fixed asset. Gross fixed assets just means the total amount that we paid for the asset when we bought it. And so the difference between what we paid and what we've written off over time is the net fixed asset line. And then finally, we have the total asset line, which is the sum of the total current assets, 1.926 million in the 2008 column, plus the gross fixed assets minus depreciation, or plus the 939,790, and that gives us 2,866,000 in total assets in 2008. Now, again, notice that it's way up from 2007, so that's something to keep in mind. That it's that certainly that this firm has made a significant investment in long-term assets, and at the same time, if you look at it, inventories increased and accounts receivables increased. Now, what we'll do is we're going to use this information to calculate some ratios when we get back from the Martin Luther King break. And so we'll tell our story then. So I'm not going to spend too much time on my interpretation of these numbers, the 07 and 08 numbers, more just reminding you about what the balance sheet and what the income statement tells us. All right, here's the liability and owner's equity side of the balance sheet. Now, we're looking at it like, sheet by sheet, but you remember you kind of draw it as a side by side. So the assets are on the left and the liabilities and owner's equities on the right. So we have the accounts payable, which is money that we owe our suppliers. Notes payable, short-term bank loans like lines of credit, money we owe the bank or some kind of financing company. Accruals are things that we owe that we haven't paid yet. So often it'll be taxes, like let's say it's March and we have a tax bill due in April, then we have an accrued amount of taxes that we owe. It could be wages. At the university, they pay faculty every 30 days. So we work for them for 30 days, and so our wages accrue over the course of the month, and then they pay us, and then it goes down to zero, and then it starts building back up in the next month. So we sum those current liabilities, again, 1 year or less. And in our case, for 2008, we're looking at $1,650,000 in current liabilities. We add to that our long-term debt. Now, that could be money we've borrowed from the bank or money that we've borrowed in the bond market, depending on how big our firm is. And then the common stock, remember what I said a minute ago, this is the money that we raised when we sold stock to the marketplace, $460,000. And the retained earnings is the money that we've made over the life of the firm that we have not paid out in dividends. Now, notice you're thinking, well, that doesn't make any sense to me because the retained earnings for 2007 is bigger than the retained earnings for 2008. Well, what that's telling us is, because I know that this is an accrued number over the life of the firm, that we lost money in 2008. And by the way, we're looking at December numbers here. We're looking at December 2007 and December 31st, 2008. So we're looking at the difference between these two columns would tell us what happened in the year 2008. And we obviously lost money because our retained earnings account dropped. Now, our balance sheet has to balance, so total assets has to equal total liabilities and owner's equity. And again, liability is another word for debt. So if I wanted to know the total liabilities of the firm, I would add the total current liabilities, the 1.6 million, plus the long-term debt, the 723,000, to get a total debt number. I don't know what it is. I don't have a calculator with me, but 2.4 million, 2.3 something million for this firm. And then when we add in the equity piece, which in our case is the common stock plus retained earnings, we get a total of 2.866 million, which if we went back to the slide before, we would know matches the total assets from the previous page. All right, now what about the income statement? Okay, the income statement is also called the profit and loss statement. The income statement tells us how much a company made, and let me back up because a lot of language gets in the way here. The top line, the sales line, that is called revenue. That's the revenue of the business, the total revenue. So we take, 100 widgets and sell them at $600,000 each or whatever my zeros will get me, and we end up with sales of $6 million. That's not profit, that's revenue. So revenue and profit are two different things. Revenue is the sales of the business, profit is the bottom line on the business. We subtract from that the cost of goods sold. That's what it cost us to make the product in terms of, if we're making tennis shoes, the canvas and the rubber and so forth. If we're making a table, the wood or the metal or the plastic. So that's the cost of goods sold. We subtract that from sales. We subtract other expenses, which often are selling and administrative expenses, like the cost of having somebody sell the product, the cost of having someone in the office who is, answering the phone, all that, those kinds of expenses. And then we also have to subtract depreciation and amortization, which is, that write-off of those long-term assets, and we'll talk about amortization a little bit later. That leaves us with earnings before interest and tax. Now, remember what I said on the previous slide, we had to have lost money. Well, here's where you see it. We have negative earnings before interest and tax of $130,948. We have to pay the bondholders or the bank the interest that we owe them. So we have another $136,000 going out, which leaves us with earnings before tax of a loss of $266,000. Now notice that the taxes, the signs are different in 2007 and 2008, and that's because we get I'm doing air quotes, but you can't see me, we get a tax refund, so to speak, because we lost money. So we get kind of a rebate on our taxes of $106,000. Notice in the previous year, we made $146,000, then we paid $58,000 in taxes. Here we lost $266,000, and so we ended up getting a $106,000 tax credit, which leaves us with a loss of $160,176. Now we could go back over to the previous page and look at that change in retained earnings from the end of 2007 to the end of 2008, and it's going to reflect this loss. So this loss gets reflected in the retained earnings account. The other thing we know about this firm is that they have 100,000 shares of stock outstanding. The earnings per share, which is the net income of the firm divided by the number of shares outstanding, they lost $1.60 a share, 60.2 cents a share. They paid an 11-cent dividend. Now, here's an interesting thing. It shows you that you can lose money and still pay a dividend, and that's what this company did. They lost money and continued to pay a dividend. And you can see that between 2007 and 2008, their stock price has fallen dramatically from $8.50 down to $2.25. And then the firm has lease payments of $40,000. Now, the statement of stockholders' equity, like I said, I don't want to spend a lot of time on this, but here's basically what it's telling us. How much equity did we have in terms of the stock that we sold plus the retained earnings that we had? You can see at the end of 2007, we had $663,768 of equity. We lost $160,000 in 2008, and we paid $11,000 worth of dividends, which takes away from our equity, and specifically it takes away from our retained earnings account. We took away $171,176. And actually, a minute ago, I said that the change in retained earnings would reflect that 160. It actually is the 160 plus the $11,000 of dividends that we paid. So let me just say that one more time. The change in retained earnings is the money that we lost, and on top of that, we paid a dividend. So that the change in retained earnings from 2007 to 2008 would actually be that $171,176, not just the 160. And so you can see that we still have $460,000 of common stock. That's what we sold. That's what we raised. But our retained earnings number is now $32,592. And that could even be a negative number. Statement of cash flows. I'm going to hold this for us to talk about when we are together. But let me just kind of remind you of what the statement of cash flows is telling us. It's telling us about what money came into our business and what money went out of our business over a specific time window, in our case, over the year 2008. And we're going to divide that statement into three categories: the operating activities of the firm, the financing activities of the firm, and the investing activities of the firm. So the operating activities are kind of how much money did we make and what happened to the short-term part of our balance sheet. And then investing comes next. Did we invest in fixed assets, or did we divest ourselves of fixed assets? And then finally, the financing activity is, did we have to borrow money in the bond market or from the bank? Did we sell more stock? Where did we get the money to do what it is that we're doing? And the statement of cash flows, if we sum the cash flow from operations and the cash flow from investing and the cash flow from financing, we will end up with the net change in cash. And we will do that when we get back together on Wednesday after Martin Luther King. So I hope that you found this little review interesting. Let me say one more thing, which I should have said when we talked about the income statement, and that is the balance sheet is a snapshot. It tells us at a single point in time where we've made investments and where we got the money for those investments. The income statement, which tells us about the money that we've made and the expenses that we've had in the business, is over a period of time. It's over a window of time. And the statement of cash flows is also over a window of time. So I could look at our cash flow for 1 day or 1 week or 1 month or 1 year. I could do the same thing with the income statement. I can look at, which is, by the way, called the profit and loss statement. Maybe I said that a minute ago. I can look at the profit and loss for 1 day or 1 week or 1 quarter or 1 month or 1 year. But the balance sheet is literally a snapshot of what's happening in a moment. So my balance sheet this morning looked different than my balance sheet this afternoon because I stopped at the store and bought some groceries and used a credit card for that. I'm in the market, so the market was up or the market was down today. That impacts my retirement funds. So your balance sheet changes all the time, but when we're looking at one, we're looking at a snapshot at a single point in time. All right, I hope that was helpful. We may do some more of these if you like it. Maybe if we're trying to work a problem or you want to see how to use a calculator or something, we can try this method to have a little bit of extra content available to you. All right, thanks. Now, here's what I was saying about getting out of this. So please bear with me. I'm not sure what it is that I need to do to stop myself. So hold on a minute. Let's see. Let's try Control Alt F10. Nope, that did not do it. Okay. All right, let's see. I am at a screen, but I still don't know how to stop myself with the Camtasia. Let's see. All right, I found it. I apologize. Ignore this last minute or so. Goodbye.